This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cashback on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 50. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management, and we got Rich Diaz at Acorn Macro Consulting. Welcome back to the show, gentlemen. What's going on? Keith is prepping for a hurricane. This might be his final episode. Keith, what's going on over there?
Yeah, but so I'm here in Halifax, and we have a pretty big hurricane heading. Fiona, that's the name. I was in Bermuda for a long time, and we were always getting hurricanes. I experienced a Cat 4 Hurricane Fabian back in, I think it was 2003 or something like that. And so Bermuda is really great in that building code requires every building be made out of concrete. The walls are literally 18 inches thick at a minimum. So the island is built to withstand this stuff. Halifax, not so much. So we're
except for your house.
Yeah, except for my house. Yeah, but this is coming at us. It'll start hitting us on Friday, and today's Thursday, of course. So we're getting ready for it today.
Bingo.
But it's going to be a big one, guys. So hopefully, no one will get hurt. But if it hits the way it's supposed to, you're going to see some pretty unfortunate and sad looking videos and photos and stuff. It's like in Halifax, we have these enormous trees all around us, and we had a hurricane maybe 3-4 years ago. I forget what it was, maybe 5 years ago. And like literally every 10th tree in the neighborhood was just like timber, coming down like the euro, like bang, like that. And I suspect we'll see it again.
Yeah. Well, get down to your bunker there. That's what you built it for. And Rich, what's going on, buddy?
Oh boy, nothing really. Just grinding away, trying to get back, find my footing back in London. It seems like every day is just full of stuff. I've been spending a lot of time at the WeWork, which actually I have to say that it's an amazing business.
Big Adam Newman fan, eh?
No, not a big Adam Newman fan, but it's funny. They have like these 5 rules, which is like be kind, be generous, and all this stuff. I'm just like, man, the guy like broke every single one of those rules.
Tequila for everyone.
But they do have beer at 3:00 every day, which is nice. But no, I've been good. Yeah, man, just grinding away. Not much to report, sadly.
Yeah,
lots of stuff going in the markets though, which is good.
There you go. Yeah, we got lots to talk about. This is episode 50 again. We appreciate everybody's support along the way. All we ask is that you continue to share this episode with at least one friend or family member. Give us a 5-star review. Help us continue to push past ArriveCan. Speaking of which, Rich, you actually called it on last week's show when we tried to not get overly political, but Rich, you said watch the Trudeau government will start to shift to the right now that Poilievre was the conservative leadership, and it sounds like they'll be removing on September 30th. They'll be removing a lot of the COVID requirements or whatever arrive can requirements on September 30th. So if you're arriving into Canada, I believe they're dropping all these restrictions now. So pretty big deal, I think.
I'm shocked and saddened. It's an extremely highly rated app. And I thought
don't worry, you can still use it if you want.
I mean, yeah, I guess I can still use it if I want. I mean, I didn't hear about that, so that's good news, I guess, for my mother, who's not exactly the most computer savvy person in the world. I can tell you it's really, really tough for older people. Like, no, all jokes aside, older people who are almost certainly boosted and vaxxed. I mean, the take up rate for anybody over like 75 is probably in the high 90s. And so the exact people who would be the least likely to break the rules are the ones that are getting hammered. And there's lots of immigrants to Canada. My mother is an immigrant to Canada. All of our friends who aren't exactly super like tech savvy. And so it's just, I mean, it's been an absolute nightmare for that group of people who, again, let's be very clear. Anybody over the age of 75 or 80 is probably not let's say 98, 99% vaccinated. So it's really sort of a joke there, but anyways, it's good. That's cool. Markets are fading. Tell us what's going on, Keith. Take your victory lap.
Keith has 3 boosters. No, I think we should.
I've had 3 since Monday. Every day you line up there to do it.
That's right.
Yeah, I'd love to we'll open up things on the Canadian front again, Canadian podcast. But there's lots to talk about. Obviously, everybody's itching for some feedback on the Fed. Keith's got some great thoughts on that. Jay Powell out yesterday. Huge moves. I think everything that we've been talking about for many, many months is all the pieces are coming together. I feel like we should start to get like that. We say like, has something broken yet? Those like Twitter accounts where it's like, anyways, I'm not going to ramble on here, but has something broken yet? No, but we are getting very, very close. Well, let's open it up here on the Canadian front. We talked about it briefly last week. We do have some of the national housing data, which came out. So I'll briefly touch on that. We just missed it on the release of September 15th, but in case you missed it, so national house prices in Canada continue to move lower. They fell 1.6% month over month in August. So the index, which measures the price of a typical home, again, this is not your average house price, which will fluctuate based on the composition of housing that's selling. This is a hedonically adjusted index. It's the same as the U.S. Case-Shiller index. So that was down 1.6% month over month. The typical home has now dropped by $108,000 since peaking in March. And national house prices are now down 12% from the highs. So that 12%, maybe it doesn't sound like a whole lot given where interest rates are, but 12% is actually the steepest decline on record dating back to when the index was created in 2005. So that surpasses, 2008, 2009 at the global financial crisis. So we're at 12%, and I think there's definitely some more room to go. But if you break that down by sort of major metro areas here, so leading the pack, the Greater Toronto area is down 15%. Again, obviously a highly levered housing market with a lot of speculation built into it, in particular in the suburbs. So that's not really a surprise there. Greater Toronto down 15%, Ottawa down 11%, Greater Vancouver off 7%, Montreal down 6%. Calgary off 2%. And Keith, I think there in Halifax, I think you guys are down about 7 or 8%. So
sorry, Steve, is it, just to be clear, it's year on year or from the peak?
That's from the peak.
Okay,
so
cool.
If you look at year on year, right? I mean, this is all like where we try to explain, obviously, to the listeners. I think, a lot of them are well versed enough, but rate of change, right? So if you look at the rate of change, like national house prices are down 12% from the peak, but they're actually still up year over year.
Right. Okay. And when was the peak? Just remind us. Sorry, when was the peak?
Officially, I think per the home price index, it was actually it's recording it as March. But I mean,
okay,
if you ask anyone in local markets, I mean, pretty much every housing market in Canada basically peaked in February.
Okay.
And if we're really going to touch on it, so every housing market essentially peaked in February, and the Bank of Canada began their first rate hike in March. So they started their rate hike. They started their tightening cycle 1 month after the largest asset actually was peaking and rolling over. So, but that's par for the cause, I suppose. But yeah, and then I think we talked about it last week, but Canadian household wealth, obviously, $1 trillion off household balance sheets. So something we'll get into, but I think Rich, you also had, so this is important, right? When we talk about rate of change perspective, right? We say, okay, national house prices are actually still up. I think they're still up like 5% or something year over year. So if you look at that, you might get a little bit confused. It depends on how the media reports it, but they're actually falling. They're down 12% from the peak. Now, if we look and apply the same sort of idea to Canada's CPI index, CPI inflation, that came in below expectations. It's growing at 7% year over year from last year. But if you look at sort of what's happening, month over month, we can see that it actually is slowly now starting to come down. So Rich, if you want to kind of walk us through some of the CPI data and sort of your perspective on that, I think it's pretty important.
Sure. All right. So I think it came out yesterday or the day before, actually. And so I'll just run us through the thing. So you're right, Steve. I think the headline number fell to 7%. So year on year, it's up, but month over month, it was down. If that's right. And core inflation. Oh, my computer there it is. Core inflation stopped rising, and I think that's really important and sits at 5.2. There are different measures of core. We'll get to that in a second. The thing that I think what's really important to remember is why it fell and how it fell. So, I think that even though the print came out less than expected, I think it hides some sort of not nefarious is not the right word, but, it hides some underlying stuff that I think is not anywhere near as positive. And you'll remember from a couple of weeks ago, that's similar to what was happening in the US. So even though the headline numbers started to come off, you have this like breadth, which I've discussed with the US. You have some of the underlying components that are still quite strong. We'll see. I think in Canada, it's a bit different than the US. I think the Canadian labor market is nowhere near as tight as the US, and wage growth and the banking credit sector is not as tight. And so I think that there's much more inflationary pressure in America, which will lead us into the conversation that Keith's going to drive us through. But anyway, so back to Canada. So we had the decline was due to goods. And so goods was peaked at, I think, at 11 or 12% and is now down to 11.5%. Remember, there's goods and services. Goods are driven by commodity prices, et cetera. And then services is much more linked to labor market and is generally more sticky, e.g. it has less volatility in the series. Within that, sorry.
Would you say that good stuff is basically just like people are basically buying less stuff?
No, I don't think so. Not yet. I think it's goods, which is what I was about to say. So in that, you've got goods as energy. So I know you don't think of energy as a good, but that's how it's that's where it's split.
It's an input cost.
Yeah. So really, I think
it's not bad.
Oh my God. That was such a bad joke. Anyway, so the reason, we had the headline number fall was because of transportation. And within that transportation, obviously also energy. So energy costs, as you can imagine, oil's come off quite a bit. I don't know exactly what we are on the Brent crude oil. Yeah, we're down to 82. I think, remember, we were up to 120 on the WTI, or 113, 114, 115. So we're, that started to feed into through these other numbers. But whereas, and the other stuff, things that are also really important as far as the major components is food's still up, healthcare and personal care, that's up. Month on month, and we know that they're high up year on year. So back to food, I think this is where back to the whole not spending thing. Yes, food is related to what's going on in commodity prices, et cetera, but it's also, if you look at, it's also demand driven as well. You've got fast food, you got from table service, and that's really struggling to basically find people to do the job basically, and that's being affected by wages, and so there's still some inflationary pressure in that area. The key, I think, takeaway was, number one, energy, number two, food, and the third one, which we've talked about a lot here, is the shelter component. And the shelter component, that started to fall. I think it's 4 months in a row now that it's fallen. So it's at 6.6 year on year, and the contribution is starting to fall. So the contribution is only about 2.6%. And then, there's questions about whether rents are rising, which I think there are, as people substitute buying houses to renting. And so there's definitely some rental pressure inflationary pressure in the rental market. And then, I think the really cool chart that I've been watching, and we've been talking, and people who have been listening to us for a year now, which is crazy, by the way, which is the producer price index, which I remove core and remove oil products from. The core producer prices. Sorry, I garbled that. So core producer prices tend to lead core inflation in Canada. Now, it's not perfect, I understand, but it's worked really well over the last, 15 or 20 years. And we were talking about this, I think 6 or 7 months ago. And lo and behold, core inflation is indeed starting to roll over. The problem is what we've seen in the US and what we might see in Canada is, even though it's no longer at the peak, it might stay quite high, which will inevitably lead to more rate hikes, right or wrong. That's what's going to happen. Keith will talk on that in a second. But anyway, so there you go. That's the story. I think that the real takeaway is we really did think it was going to peak around this time. And what is it, September? What did we say, Steve?
I think we
August?
we were earlier in the year for sure.
We were pretty good on this one, man. 1 month or 2 months away for a series like this I'm going to take that as a win. Sorry.
Yeah. Okay. You can't nail them to a T. It's what I find interesting though is the idea that, because I posted this on like Twitter, I didn't even say like, hey, yeah, it's real. You just posted statistics. People hate the idea that inflation might be coming down.
Why would you hate something that's just a fact?
I think it's like this like dogmatic view that like, I think people just want to see the world like crash and burn too. You know what I mean?
I don't.
No, I did. But I think like there's a cohort of Twitter or society in general that's just like, hey, you know what? This isn't working for me. And I want rate hikes to go into oblivion. And I don't know. It's just like, I get it. Right. I mean, it's a disdain for the existing system. Right. I mean,
well, those people should read about the French Revolution and then get back to me, because be careful what you wish for was what I would say. But the other thing, Steve, you've talked about this as well, which is the base effect. It's basically impossible for these numbers, unless you're Argentina or Venezuela and you're run by total and complete idiots rather than just people who are not so smart. It's very, very, very difficult to have these numbers ratchet ever higher and higher. Eventually the math sort of catches up with you, which is just another way of saying the base effects are important. And so that's why it's very, very difficult for those numbers to not eventually roll over and to normalize to some degree.
Yeah, I mean, if like I said, you'll see it in the YouTube comments here, even post show, that people do not like the idea that inflation could come down. But I think to that point as well, speaking of shelter inflation, I have a strong opinion. I talked about this. I was very bullish on rent growth in Canada over the last 6 to 12 months, and I think we've peaked. I think that the rental market. Yeah, the rental market, I think, has peaked.
Even with population growth at 1.3, 1.4.
Yeah, I think but I also feel, I think the rental market's peaked. I think the best day. I mean, don't get me wrong, it's not softening, but I think in terms of the rent growth, I think you're going to see that really start to taper off. And that's going to take many months, I think, as you would know better than I would, to actually filter through into CPI and in that shelter component. Because it's such a lagging indicator, the way that these agencies collect.
It's a really good point. We often obsess over these numbers month on month, but these are lagging numbers, right? When I'm talking about, just for everybody to understand, this is the August numbers that we're talking about. Sorry, sometimes we sort of skip over that, but you're right. I mean, it's just an indication. I mean, there's obviously a feel. We've said it from people have said, oh, it's only 6%. It must be way higher. Yes, there's obviously mistakes there too. This is just it's a little bit of crumb and a little bit of evidence that you need to sort of understand what's going on. It's not perfect, as you've highlighted many times. But anyway, so that's going on an inflation bit. I don't know, Keith, did you have one add?
Well, yeah, I mean, we've got that. So we had obviously Canada's inflation. Just to quickly wrap up the Canadian front here. So you actually had was it Deputy Governor at the Bank of Canada? I believe it was Paul Beaudry.
I thought it was Carolyn Rogers.
I don't know, whoever the hell Paul Beaudry
There might be two deputies, to be fair.
Yeah. Anyways, Mr. Paul, who probably doesn't listen to this podcast, he was giving a speech at Waterloo University, I believe, yesterday. So he was out saying, we got to you got to basically got to get rates up. We need to slow the economy. And then I think one of the students asked him, what he felt about recession probabilities and odds. And he's like, well, it's still too early to make any sort of, recession calls. And again, guys, I think this Keith is going to salivate here into the podcast. I mean, I think it's going to get pretty ugly. I mean, I would argue we're already in a recession. Certainly at least in the housing market. And that's given the weighting of housing, on the Canadian economy. I think it's going to filter through. But Keith, more importantly, we had a huge announcement from the Fed yesterday, so raise rates 75 basis points. There was a lot of talk going into the meeting that the Fed would raise 100 basis points. They came in at 75, but it was really the hawkish rhetoric from Jay Powell post announcement there, which I think really got markets stirring. So I don't know, why don't you sort of walk us through that and give us your thoughts?
Yeah, it was. I just want to add on a couple of points. So I think that really sort of wrap up what we were just talking about. First of all, with inflation, I don't think what you guys are suggesting is that prices are going to come down. It's just the rate of growth is going to flatten out.
Right.
So like a year from now, I do not suspect we're going to have deflation in the system.
I agree.
Yeah, unless we experience like a very significant, economic crash of some sort. And, we're not at that level here at all. The other interesting thing, I just like anecdotal stuff. I love observing things. So, I had to go down to the market there this morning to get some stuff for the hurricane, which was, beer, wine, and chips. That's what usually
umbrella.
You stack up on. Yeah, an umbrella. And, but what was interesting, this is one of the big Loblaws here. And I go in, I'm chatting with the lady, and she said, yeah, we're missing 8 people from work this morning. And I said, why? Is that normal? She said, they just don't show up for work. And I said, like, what the heck? Like, what's wrong with people? And, this is a lady my vintage. And she said, I don't know. I said, my days, you had a job, you went to work. These days, they're all university kids, basically. And, we're just sort of talking about it. And then, I think that, the world has changed in many ways. But I hope the work ethic is something has to change here, because guys like me, I'm getting older and I'm not going to be around to work hard, much longer. We need something to come up here. But I think, though, maybe, and I don't know if it's right to say this or I'm saying it correctly, but I think because governments have become so involved in our lives, especially over the last couple of years, there's this sense that maybe you don't have to work hard. I know a lot of people are working really hard because we speak with them all the time. But, it just struck me this morning with that conversation. And I see it at other places as well here around the city. But I don't know if that added any value. Probably not.
It did not. It did not because, I got to say this, because employment rate for people aged between 15 and 24 hasn't changed since 1976, because I'm looking at the chart right now. And in fact, part-time employment for kids aged 15 to 24 has actually gone up, not down, since the 1980s. So I don't know.
I think the point
old man yells at cloud portion.
No, my point is that they're not showing up for work. But
somebody come bag my damn groceries.
Yeah, bag my bag of chips for me. Anyway, maybe
I think, Keith, I think the point, though, really is ultimately, and I'm sure we're going to get the comments from it, is that, yes, these people probably should be getting paid more to offset the rising cost of living. And I think the thesis or the theme that's in play, I think, over the next, 5 to 10 years is that the power.
That was the dog. Uh-oh. The dog's in trouble.
So Rich, did you hear the one of, okay, here's Steve.
The dog's in real trouble now. Well, I want to contradict myself, because even though I'm mocking Keith about the employment rate for youth, I think it's important to remember that there are ways that you can measure it in a different way, which is from the Canadian Federation of Independent Businesses does a survey every month. And still, I think this is like I want to say the 20th month in a row or whatever. I can't remember exactly how many months in a row, but it's a long, long time. They've said that a quality of labor and so lack of skilled and unskilled labor is still their major problem. Not input cost, not inflation, not cost of capital, not access to financing. The quality and availability of the labor force and labor market is the number one thing that is the problem for independent businesses all over Canada. And again, this is a survey of thousands and thousands of businesses and et cetera, et cetera. So just to contradict my previous point.
Yeah, I was just commenting on the lack of enthusiasm shown up for work when you're supposed to.
Oh yeah, I get that.
Anyways, before I was rudely interrupted.
I had Steve, you're out of the podcast, by the way.
Yeah, before I was rudely interrupted by George. Anyways, but the point was basically that the power is moving back, I think, to labor over capital. And so you can see the rising of unions and whatnot. So I think that's something that we're going to play out, and I think that obviously filters through into wage growth, which clearly, Keith, the Fed is trying to mitigate. So why don't you give us your thoughts on that, on the Fed?
Yeah, let's now get into some really cool stuff. So, the Fed, so the first thing with the Fed yesterday was 75 base points. That was like 95% expected in financial markets. That was no surprise. But Powell came out in the presser and his guns were ablazing. And one of the very first things he said, basically in the Q&A, excuse me, was that they said, remember back to Jackson Hole, which was, just a few hours ago, really. He said, nothing has changed from that day. And if you remember we talked about it, his speech was probably 6 or 7 minutes at the most, and he dropped the mic when he finished. And the story came out afterwards. He actually had this much longer speech prepared, and they all looked at it, and he said, no, I'm scrapping this completely. I'm just coming out and say, listen, we're going to raise rates. We're going to continue to raise rates. All this stuff you guys are talking about, we are not going to pivot any point soon. Get ready for it. And that's how he started the presser yesterday. And so as soon as he said that, I was, chatting with a few of my friends that I have here in some chat rooms and stuff. And he said, oh my God, like he's going for it today. And all these questions that were thrown at him, but he basically, one of the questions was, well, how bad does it have to get before you'll stop raising rates? And he's the first thing he said was, listen, we're going to keep going until inflation's down to 2%. So there's one thought process out there. Hey, the economy is going to crash so hard that we'll see a 2% inflation number a lot sooner than people are thinking. I think that ties in what Rich was saying earlier about the rate of growth and all that. But the other part was, the question was how much pain do people have to feel? And he basically said, what did he say? He said, basically, I don't care. No, he said, no, he doesn't care. He said, there's going to be job losses, lack of bonus payments, maybe wage, your house is going to undervalue, your portfolio is definitely going to get raked over. But all of that is not as important as getting the rate of inflation down. And he just kept going at it on and on and on. And then markets just broke afterwards. And so, we like to say all the time, we're always looking for a reason to change our view. And I think you guys know our view by now. We think markets are so tight. Every day they're tightening the screws somewhere else. And the US dollar is just going to go vertical. And then along the way, that's breaking everything in its path. And that's what was happening yesterday. And you wake up this morning, it's happening again. And we got to talk about the Japanese, of course, because that was probably one of the most exciting, shocking, astonishing announcements that the Japanese did late last night or early this morning. So we'll go into that as well. But all these movements here right now, the Fed is telling you, we're going to crush the economy. We're going to crush financial markets. Get over it. Get ready. Get positioned properly. And, you will be okay with it. But again, this is where we're going. Nothing has changed with those thoughts. There.
Boom.
That was really well put.
She's gone.
As usual. I think you deserve the victory lap.
I think there was some really good comments there from Powell too. I was watching where he basically said, the U.S. housing market needs to go through a correction. He came out. Yeah, he said that people were bidding 10% over houses without even seeing them, and that we need to get back to stable growth in the housing market, which is 2, 3, 4, 5% a year or whatever. Not this 15-20% a year. So I mean, again, for him to come out and say that blatantly, that housing again is going to be another casualty of these rate hikes is pretty abnormal. But I think that this is. I mean, they're not mincing words. Let's put it that way.
He was basically taunting everyone yesterday, and I thought it was funny. I mean, like we're positioned for this, so we've been doing really well with our portfolios the last few days, but it was just shocking. He's literally like waving this in front of you. Said, "I'm going to do this. If you don't think I'm not going to do this, then you're stupid." And
the market is known for calling the bluff of, well, whether it's the Fed or other. I mean, that's what's happening, right? The market was calling the Fed's bluff, and I think the Fed's not bluffing. I think, right, in short.
Yeah, you're absolutely right, Rich. Because that, in my mind, like I think the market has called the bluff maybe 3 times now the last few months, and each time, because I like to say, I think the Fed is probably the best central bank out there in terms of trying to be consistent with transparency. Because we've said before that if the Fed believes that the market is thinking something else than what they want to do, that they'll bring them back in. They have ways of doing that, of course. They can directly tell the commercial banks, or they can, go to their favorite reporter and say, you might want to ask this question, or they can move financial markets themselves, through the New York Fed and everything. But every single time markets have deviated away so far, the Fed continues to come out. And I think yesterday was just Powell. He was just snapping. He said, guys, listen, I continue to tell you the same story. This is where we're going. So I think what's really interesting here, though, is if you look at where rates are expected to be now, like a year out. I don't recall what we said they were last week, guys, but for the Fed right now,
the whole curve is rising.
They're calling it the terminal rate. Like, at what point are they going to stop raising rates? So right now for the Americans, so they're at 3.25 right now, but for next year, like it's getting up to 4.5 to 4.75. So like there's another 150 basis points coming in rate hikes, and that's going to be a tough one. We keep saying it'll keep happening until something breaks. And, people say, well, nothing is broken yet. There's been a lot of bending going on. I mean, I think if you're down 10, 20, 25% your investment portfolio for the year, like you're not broke yet, but you're getting broker than you were before. A lot of things are going off. So like, see, you mentioned earlier about, real estate in Halifax. I think you said the number was like 6%,
7 or 8% or something, down from the peak.
Yeah, like I know, like just anecdotally, that number is BS. I bet you it's 20% plus from some of the
I mean,
I know of, right? It's
and that's the problem. These hedonically adjusted like indexes, right? They're smoothed out. They tend to lag a bit as well. So I mean, again, Vancouver, they're saying is down 7%. Fun fact for anyone that's, in Vancouver. So we have like suburban house markets that are down easily cut and dry 20% from the peak. And then you go into like some of these condos in the city, like where I am here, the prices have not changed at all. They're flat, which is actually insane to think about it, because you're like, wow, like interest rates are up, 300 basis points. Your mortgage rates has more than doubled and the price has not moved. So there's all these sort of variances. And so when we say Greater Vancouver is down 7%, we're taking detached condos, townhouses, we're lumping them all in from all these different municipalities and giving you one number. So it's not perfect. But there are certainly pockets of the market that are getting crushed. And again, some of these suburban markets down 20, could they drop another 10, 15, 20%? Like that's painful.
Can I just add something? Can I just add something to your story, Keith, which I think is important just to remind some of our listeners?
Steve and I have a thing going on.
No, I'm doing it. I think one of the, we're talking about the terminal rate and when we think the Fed will end and what rate it is. And I think it's important to remember that the US has a dual mandate, which is, inflation and then, stable inflation around 2%, whatever it is. And then obviously the labor market. And I think the reason why, I had a client call the other day and I said, the Fed funds rate might get to 5%. And she was like, 5%, that'll destroy all of my emerging market positions. So Keith, you'd be happy to hear that. But the reason I believe that is because the one thing that you sort of left out in your little spiel there, which is the labor market. And the labor market and I think Powell mentioned this, a couple of times, is like the labor market is just so tight. And I'd love to see on, what is it, the first Friday of every month or the last Friday of every month? I can always forget, but the non-farm payrolls, I think, is going to absolutely smash the expectations. And it's, again, because of things we've talked about, Steve alluded to it, which is the age dependency ratio, not enough young people versus the spenders, the old and young. We've got extremely strong wage growth as an indicator. America has the lowest population growth I think it's had basically, I don't know what to say ever, but in a very, very, very long time. Contrast that with very high population growth in Canada. And that's driving the wages that are really strong, wage growth. If you look at the employment cost index, which includes sort of benefits and other sort of non, pay related compensation, that's in the 9-10%. And, this is where I think, I think that, and then if you look at, things like initial jobless claims, continuing jobless claims, if you look at labor shortages, the JOLTS thing that I always forget what the thing, like virtually every single labor market metric that you can come up with is still not only strong, but in some cases getting stronger, and certainly at the minimum, extremely tight. And I think that's part of the reason why Powell has what he feels is his runway. I mean, that's the way I sort of see it. Also, the S&P 500 is only at, it was 15 minutes ago, it was at 3761, and so we haven't really had any pain at all in the equity market, plus the strength of the labor market. And so that's why I think, when we look at these forward curves for the Fed futures rate that you said, Keith, we're ratcheting higher and higher in that term. I mean, we shouldn't be surprised at all to see that just get into the fives. I don't know, that was sort of what I was saying to my client. And I really believe that until the labor market starts to squeak, I don't know.
Quick comment on that before Keith jumps in. So just a quick note on the Fed. So today, 12 of 19 Fed officials expect Fed funds to be between 4.5% and 5% by December of 2023. So that's kind of 4.5% to 5%. It's kind of where they're expecting things to be. In December of 2021, they expected a 75 to 100 basis point Fed funds rate for the year end of 2022. So, I mean, again, this kind of just highlights their forecasting abilities. I mean,
no, but they're behind the curve. That's the thing. They all thought inflation was transitory, which is what this is exactly. I mean, I have a presentation this weekend, and one of my slides is comparing the debacle that was the Fed fund policy in 1946 to 1951 and what's happening now. And if you look at that and you compare it, it's honestly, it's wild how it's like the history repeats,
Well, we've got another little fun stat there's just so many things that they got wrong. And I don't know, everybody, I mean, so this is in February of 2021. Powell said that M2 money supply growth, which was running at 26%, would not spur inflation. It's something that we need to, quote, unlearn. And then we've got, just another quick update on the Fed as well. This is from Larry McDonald of the Bear Traps report. He says the Fed sees PCE inflation all the way down at 2.8%, with GDP up at 1.2% for the end of 2023. So by the end of 2023, Fed PCE inflation will be down at 2.8%, but GDP will be up at 1.2%. And he says that's up from 0.2% in 2022. So GDP is going to be up and inflation is going to be down in 2023. So it kind of doesn't really square the hole there with the fact that you got to crash the economy to actually get inflation down.
I think there's a lot of we continue to see a lot of data points that it cannot be reconciled. So, and again, so it's interesting because we did talk about the economy. It's going to come off, and now it seems like it is going to roll off. But even I saw an article this morning. One of the BMO guys. I don't know if you saw
Which economy? In Canada, you mean?
What all of
I mean, Canada's screwed.
This is Canadian specific now. So the BMO fixed income head, not his feet, his head, sees 99.9% odds of a Fed-induced recession. So I know he's going on and saying, hey, like we're headed for a recession now. Remember, we went from a period a few months ago to recession talk was stupid. Like why even suggesting it? As we get closer, it's no recession, but we're going to slow down. Now the conversation is, we're definitely going for a recession. And, what I suggest is very high probability. This ain't going to be a little small recession. It's going to be a thumper that's coming up. And that's not bad because it just means there's some great ways to make some money here. But with all the central banks raising rates, everyone is struggling. They're all, synchronized with what they're doing. But it's just going to create this, uncomfortable environment. So if you look at Europe, for example, my favorite market I like to look at, because I think it's maybe now the second best market to make some money on. But the ECB, they're raising rates. They might have to stop doing that, but they're going to raise rates. They're going to do more QE coming up. They're trying to bail out the Italians on the 10-year. They have this energy crisis that's continues to develop. And, I was chatting with a guy a couple of days ago. He's one sharp guy in the energy world. And I was asking about the German economy with energy. And he said, Keith, if the weather is mild, like it's not as cold as what it usually is, he said, they'll be okay. Like they'll get through it. It's not to be confused with it's going to be awesome or anything, but, there is a path where they can get through the winter and it'll be fine. But anyway, but Europe is in trouble, which sort of leads to what's happening in Japan right now. And do you guys want to talk about Europe again before we move over to Japan?
Well, I was just going to say the Italians, there's been viral videos going online that the Italians in Naples there, which I was just there about a week ago, are in the streets ripping up their energy bills and protesting. So thank God I got out of there.
Well, I mean, did you hear about the community paying 10x or something? I don't even know if this is true or not. So I'm going to maybe I shouldn't have said it so cavalier, but I heard of there's a town in Italy somewhere that is having to pay 10x their previous August energy bill, which is just, these numbers are absolutely mind-boggling. And I don't think, and we know we've talked about this a lot. I don't think the ECB raising interest rates in Europe is going to help what ails Europe. The demand for energy will remain, and they don't have any of it. So it's
because Rich, one thing that you did really well for a while now, you're introducing everyone to the concept that energy markets, specifically oil and then nat gas as well. I don't want to use the word permanently, but somewhere between permanent and temporarily, it's been, what's the right word? Not destroyed, but progress has been stopped. Completely
castrated?
Maybe. But,
neutered?
So we have that, and they can't turn it on. So, you're right. Raising rates won't fix any of that. But let's look at the Japanese. And because we've talked before how, they've run into a real challenge over there, and that they had to stop interest rates from rising. And so that, by the way, that means not only do they not raise interest rates, it means that they're going to prevent the entire bond market from going down in price, which would mean yields are going up. So they capped the yield curve, and by doing that, it meant the yen was just getting crushed. Like it's a one-way bet. And then finally, last night, the Bank of Japan, and they did it on behalf of the Ministry of Finance, they started supporting the yen. So here they are now, they're trying to save the bond market and save the currency market. So yen has probably had a 2.5% round trip here this morning. But from an investment perspective, so I look at this, and so I do manage a private fund, so we're able to take advantage of these moves as opposed to just simply long only stuff. But in long only stuff, we're short yen. We're doing well with that trade. But so right now, we look at what the Japanese are doing, and it's one thing for them to protect the bond market, but to protect the yen means that they're selling their dollars, to buy yen in the marketplace. And people who are perpetual or perma bearers for the dollar, they say, there it is. There's another big player selling their dollars, treasuries first to get dollars and then sell it. See, it's going down, which of course is only one way thinking, because someone is buying it on the other side. But let's just say you're in Japan right now, and you're sitting on all this yen, and you're a smart firm or family office or individual, and you say, holy smokes, this is the last opportunity I have now to sell my yen and to buy dollars or buy euro or CAD, whatever you want to do. So the domestic guys now, they're saying, I'm out of here. They sell and get out. If you're Japanese and you have money outside the country, and this is the other big story today, all the Japanese are going to expatriate their money back in. Maybe some guys would do that, but if you're a smart guy, say you're living the life over in Naples and you have a lot of money there to pay your energy bills and stuff like that, you're saying, why the hell am I going to put my money back in yen when I know that it's only one-way street? They can go down in value. And then at the same time, if you were a foreign investor, you're not Japanese, you have no ties to Japan, but you're thinking, I think we should open a new manufacturing plant somewhere to do this or that. Let's look at Japan, and you're going to get a tap on the shoulder and say, oh, wow, if you put your money in Japan now, you're buying yen, and that's a one-way loss as well. So I mentioned that, Europe was always my favorite market that could, trigger this big crisis where something could break. Now it's the Japanese. They're sitting there now pretty lonely. So everyone watch the Japanese market, the bond market, as well as the currency market, what the Bank of Japan is doing and the Ministry of Finance. But for these guys to come out and explicitly say, hey, we're going to intervene in the FX market, because they're the first ones to do it. It means things are really tight. So maybe the Europeans go next, maybe the Canadians do it, but this US dollar wrecking ball, it's wrecking stuff right now. And at some point it'll be over, it'll be a good time, to transition out. But, I just can't state enough this week and then last week with the CPI number, like this is going, exactly as we expected. Not exactly, 75% as we expected. It's a great way to make money if you're on the right side of the trade and you can see which way it's going. But that's the big news in Japan and sort of with Europe, and it's affecting Canada.
Well, speaking of Canada, Canada's just so lucky we have as much energy as we do. I mean, if you look at the market selling off quite a bit today, including the bond market. Remember, we talked about that last week. Both the bond and the stocks are moving down together, which is, if Powell wanted to freak people out, that's one surefire way to do it, is to get, long-term bonds to sell off 1.6, 1.7%, which is a lot, by the way, for a bond market, especially 20-year bonds, as well as the equity. But the sector that's actually still up on the day, which is, and the reason I'm laughing is because I guess, one of the things, I've gotten a lot of things wrong in the last year or two, but this is definitely one of the things I got right, which is the energy market is going up. And the reason I bring that up is because I want to read a quote that you guys shared with me, but I think it's just amazing. It really, really speaks to what's been going on here. And I think it's important that our listeners listen to it. And it's from the Aramco CEO. Now, the CEO of Aramco, Aramco is owned by a country that I don't think is particularly, let's say, good, or let's say I don't share the values of that particular nation. But be that as it may, the CEO absolutely nails it. And I quote, "When you shame oil and gas investors, dismantle oil and coal-fired power plants, fail to diversify energy supplies, especially gas, and oppose LNG, liquefied natural gas, receiving terminals, and reject nuclear power, your transition plan had better be right." And I want to finish that quote by quoting someone else who I also don't necessarily think is a particularly moral or virtuous person, but this is probably one of the best quotes ever. And to quote Mike Tyson, everybody has a plan until they get punched in the mouth. And I think those two quotes together really explain a lot of what's been going on over the last little while, whether it's, the collapse in the current account balance in Italy after they've had basically a great run of sort of reorganizing their economy. I know Keith doesn't agree, but that's my view. The current account balance in Europe, which has been 3% of GDP in perpetuity, which is basically the only reason that economy has basically survived, whether it's Japan, a lot of these countries basically over like that energy policy blunder, it is going to cost lives. And it's going to, it's meaningful when you ignore physics, when you ignore reality, when you underinvest in critical infrastructure because of a hope and a prayer, when you ignore nuclear power. I know people have heard me rant about this for a long time, and so I'm going to spare you guys today, but it's really, it's really, really sad. I think we need to revisit a lot of this, and maybe this crisis, is what it takes. As we both know, that's not what's happening in Europe. They're doubling down on these dumb policies, but hopefully if the euro does go to zero, Keith, maybe they'll start building some liquefied natural gas terminals in northern Germany and sort of change their mind on this product. And hopefully Canada, the takeaway from Canada is that we can really step in and help the world with the most important commodity in an ethical and safe and environmentally friendly way. And I don't know, it'll be really interesting. I think it's really sad. I mean, what's happening in Italy. And
so Rich, what has to happen, you think? Because, we all know this, and, our listener knows this. But I'm still not hearing the message from government policymakers today. Like, first of all, they'll never admit they made a mistake. But I don't know, maybe I'm wrong. Is there a solution?
Sorry. Is there a solution? I think in Japan, they're revisiting their nuclear stance, which is, to me, great. Japan has excellent engineers, excellent infrastructure. It's safe. It's basically not corrupt. It's on a tectonic plate fault, but had they better insulated their generators when the tsunami came, they wouldn't be at Fukushima. And they've learned that lesson, and that's what humans do. Hopefully, they learn and they move forward. So Japan has walked back its ban. They're gonna revisit opening 9 nuclear power plants. Germany, I think, is going to face that fact as well. They've walked back that. Europe recently, a little while ago, they voted on whether natural gas and nuclear power is quote unquote green. Greta, who is, in my view, one of the most dangerous human beings on the planet, obviously said that was a bad idea. Thankfully, the European Parliament voted in favor of making nuclear power and natural gas quote unquote green. And in Canada, I think we're about to see, sorry, I'm laughing because it's going to get really ugly, this politics in Canada. I think we're about to see what's going on. In the US, I don't know. I think in the US, I think there's people like Jamie Dimon, who today was asked by a congresswoman whether he would stop financing oil and gas project. And Jamie Dimon, like a sensible person that he is, said, no, that's basically the road to hell in America. I think all the adults in the room understand this. I think the problem is when you let children determine economic and government policy, I think you get into trouble. And so, yeah, Keith, I mean, I do think on the margin that you have people who are much more open to nuclear power. I know this anecdotally. My friends who, months ago would have never thought about energy policy, all of a sudden are like, yeah, why don't we do more nuclear power, et cetera, et cetera. But nuclear power is 6% of global energy. 83% of all the primary global energy is fossil fuel. So in order of importance, it's coal, crude oil, and then natural gas, and then well below hydro, non-hydro renewables, and then nuclear power. And so the screwed up thing is we've spent 20 years, or not 20 years, sorry, we spent about 10 years or whatever, naming and shaming people who have been building critical infrastructure. And then now when we need it, they blame the oil execs who haven't, to me, it's just, I'd like to, if I could just, I just really call attention to all the people on LinkedIn who are insisting that ESG is a good way to run the world. Hopefully they'll stop posting, but I see it at the margin, Keith, but I think it's very, very hard politically to turn your boat around after years and years and years of telling everybody that there's only one way, one road. There's only one road to perdition, and it's through solar and wind and solar and wind and solar and wind, to turn around and go, hey, maybe we should build a nuclear power plant or two, or natural gas, which, let's remind everybody, natural gas is 50% less emissions than coal. I think
so. It's also, though, it's a bit of a race against time, though, as well, because it takes a long time to do that. And I think the financial market fuse is a lot shorter,
right,
than the change to more nuclear for that fuse, as an example. So I don't know if we're, I think we, again, I don't have a pleasant message, for people with markets. Yeah. And however, there's ways to make money out of it. So don't be.
Well, that's it. My energy is my only overweight. And I go to client meetings, and and they're like, well, what are you overweight? I'm like, I'm the only sector that I think you should own. And again, this is not investment advice before I get myself in trouble, but the only sector that I like is energy, because of the supply demand issues that we've discussed at length here. Otherwise, and today is a really
so I think a portfolio
example,
just long US dollar, which is short all the other currencies, and long energy, and you'd be pretty smart this year.
It would never pass your prospectus.
Yeah, but you could buy a place in Kitsilano and have a nice little rooftop patio and stuff like that. What do you think, Steve? What are you hearing on these thoughts?
I think Rich, I was just sitting there listening. I think it was a tremendous rant. I think, I like this podcast every week because as much as I enjoy the banter, I'm learning, right? I mean, like, I don't know all the answers, and I get a lot of things wrong, and I just, like to come here and learn from you two. And it's, it's a discussion, right? And this is always what the podcast was about, right? It's not like us telling everybody, that we know everything and follow all of our advice. It's like, no, listen, we're all learning. We're going to make mistakes. But it's about having intelligent, educated, objective conversation, and hopefully that can get sort of the creative juices flowing. And we basically just want to help people think for themselves, I think, is really the idea here, right? Let's sort of cut through the noise, and we're on a platform here that allows us to really speak our minds, and we control the platform and the podcast, right? So
we can control your thoughts at this very moment.
Well, no, but I mean, to Rich's point earlier, right? It was like, oh, okay, well, like, how do you convince, like, politically, how do you transition from like all we've been told through government and media and culture? More importantly, culture and society has been told that, yes, like, oil and gas bad, wind turbines good,
nuclear bad. We've been told that too.
And so now, how do you then turn around and say, hey guys, like, well, by the way, we're now having to ramp up and use more coal because we didn't invest in LNG. It's like, oh, you can't. It's too tough to reverse. So anyways, I mean, like I said, hopefully this podcast continues to sort of, be a beacon of light and education. And,
so you hit a really good point, because I think, years ago, the internet didn't exist. So everyone's views on stuff it was completely shaped by the media. That's what it was. And if you thought differently, then, you were just weird. And so that's great today. So, we can have this podcast, someone else can do another one, which have complete different view, but it gets people talking and thinking. The other thing, because I think that you go back to markets again, because like, I'm always markets. That's the way we act and look at things. It's sort of a bit different than this, but the market is always on the belief that, hey, the Fed is going to save us. The central bank is going to save us, right? They call it the Fed put and all that. But, and this sounds really stupid, right? But, back when I was a kid, it was, we had like the $6 million man and Fonzie, they could save the day with all that stuff. And you're looking around today, if the Fed is gone, who's going to save the day? And I think what's great is that us now as individuals, you can save yourself. You could do with this stuff, because you have more information. But what's absolutely going to happen next? Remember when Draghi? No, not Draghi. It was JC, Jean-Claude Juncker. The
Trichet.
Prime Minister of. No, not
Oh,
Trichet.
sorry.
Juncker. Yeah.
Sorry.
The Prime Minister of Belgium, and then he was the EU president, for a while. And the guy's always drinking the bottle all the time. By the way, there's some epic YouTube videos of him drunk at so many different events. Like it's really funny. But he's the guy that years ago said, hey, like when it's serious, you have to lie. And I think now we're back at that point again financially. And the Fed, they weren't lying yesterday. They actually gave you a big, dose of truth. And so we have to start watching now what policymakers are saying, what are they telling you, and things like that. But, again, I think, for equity, we've been very light on equities this year, so it's been helpful for us. But I think we're almost done. Like we're not
Really?
there yet.
That was my question for you. What are you looking for? I wrote a question for you, and it was like, what are you looking to see as far as the capitulation from the Fed? When do you think? What if you had to list like 2 or 3 things? But in general, the market and the Fed, to me, they're connected, right?
Yeah, I think more around time zone. I think timeline. I think we're a few weeks to a few months away from a bottom here.
Really, that short?
I think so. Yeah. It could get flushed out pretty hard, right? The final one.
Right.
And, we'll tell everyone, when we're buying, but it'll be like 3 weeks after we bought, that's what we're going to do. But, don't get caught.
But you really think it's only just a couple of months? You just think,
yeah.
I mean, I'm not going to hold you to it. Don't get me wrong. Please don't get me wrong. I'm just trying to understand sort of your thought process behind it.
Yeah.
It can happen that quick.
Sometimes it's just, sometimes it can be, okay, like that's enough. You know what I mean? Because markets will pivot pretty quickly. So we could be, getting closer, but that doesn't mean the economy has improved.
Right.
That doesn't mean this is done better or whatnot. It's just that when there's no one else left to sell, by default, there's only buyers remaining. But the trick, of course, to make sure you have money and capital available, to do that. And because you make a great point earlier, Steve. I think when you're talking about the M2 growth on the Fed's balance sheet, I think you referenced June of 21. I think it was. And I was listening to this podcast. I think last week.
February 2021.
Was it? Yeah. Last week you were going on with something that I wasn't interested in, so I just
sounds about right.
Out. Yeah, but not this week. I'm tuned in this week. But when you can see that rolling over, it seems highly likely that risk off would happen, and it did start to happen about 6 months later. And now we could be getting the point where you just get the opposite taking place. So remember, like linear thinking, my God, like that'll kill you in financial markets, because by default it means equities go to zero. Euro will go to zero. That's not a good example, but but that's where we're going. So don't worry, be concerned, and don't be happy, but we are getting closer to some really great buying opportunities coming up. And one of the markets that we love, we've been, it did really well at the beginning of the year. Now it's come off a little bit, and but we've been adding to that now over the last couple of weeks. I'll tell you that one now in a couple of weeks from now what it is, because we're still not finished adding to it. But it's one of these long-term themes that, like Rich, you've talked about it before as well, and it's all tied in with everything else. But again, if you're just patient and you pile on to these things, and then
But that's why, actually, Keith, I didn't know you were so squishy and positive. Who knew you were an optimist? But I think that's actually how I sort of feel about the energy policy, because I believe that we should move away from fossil fuels in a sensible and adult way. And I think that, maybe this is the crisis that we need. Just to answer your previous question, this is the crisis that we need to sort of expose the childish ways that we're going to sort this problem out, and focus our energy on the longer term structural ways that we can deal with this fossil fuel question. Make no mistake, human beings will basically always consume fossil fuels. It's way, way, way too useful. There's too many industrial applications. But for energy, for like a power, you know, and that kind of thing, I think that maybe this is the crisis that we need to everybody go, okay, let's just sort out the nuclear question and let's start building lots of hydroelectric dams. There's no reason why Canada cannot do that in incredible amounts and then sell it to America, or why why there shouldn't be nuclear power plants all over Germany or whatever it is. And so, yeah, I think you're right. I think in a way, the crisis sort of focuses those minds, doesn't it? And hopefully people
Well, I've been incredibly optimistic on the US dollar.
I've been really optimistic on XLE, which is the US energy ETF.
I think that's a good place to wrap it up. I think just, in summary, be diligent out there. We don't like to mince words, but it is going to be a challenging, 6-12 months ahead, and there'll be opportunities, and, just try to position yourself obviously accordingly so you're on the right side of those opportunities. But I think that's a good place to leave episode 50. We're getting close to the episode 52, the 1-year anniversary. So we'll see if we can kind of try and line up something fun for that. We're still working on our event details for Toronto. The date is confirmed for December 1st, just working on the venue and some final details there. So we'll announce that shortly with the link to get tickets and whatnot. So as always, we appreciate your support. We'll see you next week.